Jonathan had nearly $10,000 in his account. His card was declined, and when he tried to find out why, the algorithm gave no explanation. A single email, no phone call, no human being to speak to, just a sentence that closed his account, blocked access to his money, and offered nothing beyond. Suspicious activity. How does a financial system do that? Lock a person out of their own money, with no explanation, no appeal, and no way to challenge the decision. The algorithm didn't ask where Jonathan lived. It didn't have to. It already knew, from data points you never agreed to share. And if it knows that about him, it already knows that about you. By the end of this video, you'll know what your address already tells the system, and exactly what you can do about it. This is the invisible wall. The story of financial algorithms starts with a promise that sounds impossible to argue with. Remove human bias from lending decisions. Human loan officers made subjective calls. They could be prejudiced. An algorithm couldn't be. That was the pitch. And it was compelling. The problem is what the algorithm learned to call risk. To understand what happened to Jonathan, and what may be happening to you right now, you need to understand one specific mechanism. The algorithm doesn't use your race. It can't. That's illegal. But it uses your zip code. And in the United States, zip codes are not neutral data. They are the direct descendants of redlining, the government-sanctioned practice of marking black and brown neighborhoods as high risk and refusing to lend there. The lines changed. The maps changed. The names changed. The data didn't. A 2024 analysis by the Urban Institute found that black and brown borrowers were more than twice as likely to be denied a mortgage as white borrowers with comparable financial profiles. And a 2022 study by UC Berkeley researchers found that even in fintech lending, the kind that claims to be purely data-driven, African American and Latino borrowers were charged nearly 5 basis points more in interest rates than their credit equivalent white counterparts. $450 million a year. Not because of any declared intent to discriminate, because the data the algorithm learned from already encoded decades of discrimination. The algorithm learned the history, and then it scaled it. But before I show you the scale, you need to meet Jonathan. Because what happened to him happened in a single afternoon. And it started with twins, an Applebee's, and a stimulus check. Jonathan Marrero is a 32-year-old motorcycle technician from New Jersey. In early 2021, his federal stimulus payment landed in his Chime account, a digital bank serving an estimated 12 million customers at the time. His balance was nearly $10,000. The day after the payment arrived, he took his 5-year-old twins out for lunch at an Applebee's near his home. When the bill came, he tapped his Chime debit card. Declined. He pulled out his phone and tried to log into the Chime app. He couldn't. In his email, a message from Chime. No explanation, no appeal process, no number to call that would provide a reason. Just, the relationship is over. Jonathan had to call his parents to pay the lunch bill. He later described the moment in an interview with ProPublica. For more than 2 months, Jonathan was locked out of nearly $10,000. He had to rely on credit cards and family loans to cover basic expenses, groceries, gas, rent. He eventually filed complaints with the CFPB and the Better Business Bureau. In late May 2021, after more than 2 months, Chime reopened his account. Chime confirmed to ProPublica that it had made an error in closing his account. The reason? Given for blocking him for over 2 months. Suspicious activity. No further explanation was ever provided. Jonathan's story is not unusual. It is not even uncommon. At the time ProPublica published its investigation, Chime had accumulated 920 complaints with the CFPB in a single year. Thousands of customers were locked out of their accounts, many with no explanation. In May 2024, the CFPB took action. It ordered Chime Financial to pay $3,250,000 in penalties and at least $1,300,000 in redress to affected customers. The CFPB found that Chime had failed to refund account balances within 14 days in thousands of cases, in some instances waiting more than 90 days. For people without other sources of income, that wasn't a delay. That was a financial crisis. The algorithm didn't know that. The algorithm was never asked to know that. If you've ever had a bank account closed, a loan denied, or access to your own money blocked with no explanation, say so in the comments. Drop the institution name if you remember it. Patterns become evidence. Let me show you exactly what the algorithm is doing. A financial algorithm cannot legally ask your race, but it can use your zip code. Your zip code can reveal the median income of your neighborhood, the historical rate of loan defaults in your area, the proportion of residents who are unbanked or underbanked, the rate of property value growth or decline. None of those are your personal financial history. All of them are proxies, statistical stand-ins that correlate with race in the United States because of the history of where people were allowed to live. This is what regulators call disparate impact, a practice that appears neutral on its face, but produces discriminatory outcomes in practice. The algorithm never says, black neighborhood. It says high-risk zip code. And those two things, in this country, map onto each other with frightening consistency. On January 12, 2023, the U.S. Department of Justice announced the largest redlining settlement in its history. The bank, City National Bank, based in Los Angeles. The finding, from 2017 to 2020, City National had systematically avoided making mortgage loans in majority Black and Latino neighborhoods across Los Angeles County. The DOJ's Combating Redlining Initiative, launched in October 2021, has recovered more than $122 million in settlements since its creation. The cases include Ameris Bank in Florida, First National Bank in North Carolina, the mortgage firm in Miami. Each case tells the same story in a different city. A bank draws an invisible line around certain zip codes, not with a pen, with an algorithm, and the people inside those zip codes stop receiving the financial services that build wealth. Here is what makes this different from the redlining of the 1960s. When a human loan officer made a biased decision, there was at least a person, someone whose judgment could, in theory, be questioned. A complex algorithm produces a score. The score produces a decision. The decision triggers a rejection. And in 2022, the Consumer Financial Protection Bureau confirmed something important. The law requires that any credit denial come with a specific, accurate reason. Not does not meet criteria. A specific reason. The actual factor that drove the decision. The CFPB's position is clear. If your algorithm can't explain its decisions, you're not allowed to use it to deny credit. Most institutions are still using it anyway. From a risk governance perspective, which has been my field for 16 years, this has a precise name: systemic risk laundering. The discriminatory outcome is real. The accountability is diffused across the model, the vendor, the institution, and the data. Nobody intended it. Nobody is responsible for it. And the person denied the loan has no idea it happened. But the money moves anyway. $450 million a year in extra interest charges, extracted from Black and Latino borrowers who are credit equivalent to white borrowers who pay less. That's not a rounding error. That's a transfer of wealth, automated, invisible, and scaled. None of this means every denial is discrimination, but it does mean that discrimination can now operate inside a formula and scale to every application submitted in America today. This is Shadow Structures, where we investigate the systems that shape your financial life without you ever seeing them. If you want to understand the full architecture of how invisible algorithms control access to money, jobs, and housing, subscribe. This series is just getting started. Before I give you the full picture, I need to speak to you directly. If you've ever been denied a loan, a credit card, or a bank account with no explanation, or with an explanation that made no sense given your actual financial situation, it may not have been your credit score. It may have been your zip code. And you'd have no way of knowing. Now let me show you the scale. You've just seen 3 layers of the invisible wall. A fraud detection algorithm that locked a man out of his own money for more than 2 months. A mortgage lending system that drew invisible lines around Black and brown neighborhoods and called it risk management. And a market of thousands of financial institutions using models that can't explain their decisions and aren't legally required to. And all of it legal, all of it still operating, all of it growing. EP04 showed you the algorithm that filtered your resume. EP05 showed you the algorithm that scored your face in a job interview. This one decides whether you can build wealth at all. The same logic, a different domain, the same invisibility. The DOJ has recovered $122 million in redlining settlements. That sounds like accountability. The U.S. mortgage market processes over $1.5 trillion in loans per year. $122 million is less than a rounding error. The algorithm ran through the settlement. It's still running. So, Jonathan was locked out of $10,000 by an algorithm that admitted it made an error. City National Bank paid $31 million for drawing invisible lines. And the system is still running. What does that mean for you? It means the algorithm already has an opinion about your address. But understanding that gives you more control than you think. Here is your toolkit. 1. Request your adverse action notice. If you were denied credit, a loan, or a bank account, the lender is legally required to give you a specific reason under the Equal Credit Opportunity Act. Not a generic reason, a specific one. If they give you does not meet criteria, that's not compliant. You can file a complaint with the CFPB. 2. Check your CFPB complaint database. Before applying to a lender, check whether they have a pattern of complaints related to unexplained denials or account closures. The CFPB maintains a public database at consumerfinance.gov/data-research/consumer-complaints. Patterns in that database can tell you more about a lender than their marketing ever will. 3. Know your HMDA rights. The Home Mortgage Disclosure Act requires large lenders to report data about who they approve and deny by race, income, and location. That data is public. If you're in a neighborhood with a history of redlining, you can check whether your lender has been approving loans in your area at the same rate as comparable white majority neighborhoods. 4. If your account is closed without explanation, file a CFPB complaint immediately. The Chime settlement established that fintech companies must refund balances within 14 days of account closure. If it has been more than 14 days and you haven't received your balance, that's a regulatory violation, and the CFPB wants to hear about it. 5. Consider a credit union or community development financial institution. CDFIs are specifically designed to serve communities that traditional banks underserve. They use different underwriting criteria, often more flexible, and are not driven by the same optimization targets as commercial banks. The CDFI Fund at the U.S. Treasury maintains a public locator at cd5fund.gov. The algorithm doesn't know you. It knows your data. And some of that data is wrong. Some of it is biased. And some of it can be challenged. The invisible wall isn't made of concrete. It's made of decisions, encoded in models, running at scale, with nobody's name on them. Knowing how it works is the first crack in the wall. Jonathan never got a clear answer. You can, if you know what to ask for. When Jonathan tapped his card that afternoon, he thought he was paying for lunch. He was actually interacting with a risk model that had already profiled him, without his knowledge, without his consent, and without any obligation to explain itself. What happened to Jonathan isn't an anomaly. It's a preview. When you click Submit on your next loan application, you're not asking a person for money. You're submitting your data to a model that already has a score for your neighborhood. Shadow Structures investigates the systems that shape your life without you ever seeing them. This was the invisible wall. We've now seen 4 systems. An ATS that filtered your resume based on your zip code, your school, your employment gaps. An AI interview platform that scored your face and your voice before a human saw your name. A banking algorithm that closed your account without explanation and blocked access to your money. All 4 of them operated on the same principle. You submitted information. The system made a decision, and you were not told why. In the next investigation, what happens when the algorithm doesn't just screen you, it scores you permanently and shares that score with other systems you'll never see. It's called an alternative data profile, and it already exists for most American adults. The resume filter saw what you wrote. The interview AI saw how you moved. The banking algorithm saw where you live. The next system sees all of it. If you've ever been denied access to your own money or denied credit with no explanation, share this. The system is most powerful when it operates in silence. Jonathan got his money back after 2 months and a CFPB complaint. Most people never file the complaint. The algorithm counts on that.
Yeah.